You're watching Deal Flow, the show that looks at deal making in South Africa and across the African region. We assess the prospects, the numbers, and the passion as we talk to the people behind these deals. I'm Erika van der Merwe. Carlo Gonzaga, the man behind Taste Holdings, is our featured guest this week. We're seeing a theme of consolidation and expansion in the fast food and restaurant market in South Africa and in Southern Africa. Now, Taste Holdings recently announced its acquisition of fast food franchise Zebro's Chicken. We find out from Carlo what exactly goes on behind the scenes when doing such a deal. But let's take a quick look first at our deals of the week.
South Africa's Bidvest said it had raised its stake in drug maker Adcock Ingram to more than 34%, enough to block a rival $1.2 billion bid and prompt Adcock to seek urgent talks with its Chilean suitor, CFR. Glencore Xstrata plans to sell its majority stake in the $5.9 billion Tampakan copper and gold project, its partner in the long-delayed Philippines joint venture said recently. Zynga will shed 15% of its workforce to slash costs and buy mobile game developer Natural Motion for $527 million to refresh a stalled games pipeline. Etihad Airways and Alitalia are in the final phase of due diligence for a possible investment by the Abu Dhabi carrier in the troubled Italian airline. Sources close to the matter say the investment could involve Etihad buying a 40% stake for as much as €300 million.
Last week, JSE-listed food retailer Taste Holdings acquired a small chain of eateries, Zebro's Chicken, for 17 million rand. The deal is yet another example of what seems to be a general scramble for the heart and indeed the stomach of the South African consumer. Carlo Gonzaga is the man wearing the chef's hat at Taste Holdings. Welcome, good to have you here.
Great, thank you.
Now, Carlo, you have indicated what the rationale was for the deal. And to me, there are two elements. The one is it gives you access to the value market, of sort of the lower end of the consumer market. And the other element, I think it gives you an opportunity to benefit from or to implement your dream of vertical integration and scaled benefits.
Yeah, so, and I think that you've captured it pretty correctly there. I think our foray into the lower LSM market started with our fish and chip acquisition 2 years ago. And we've spent 2 years now, we've really learned a substantial amount of things. You can do all the due diligence you want, but only when you really own the business for a while do you really understand the business that you bought. So this definitely gives us yet another entry into that lower LSM market, which I think we now are probably one of the leaders behind KFC in that segment in terms of store numbers. And secondly, we've already got this big infrastructure of distribution and manufacturing, and this just adds more volume to that, which really at the end we get to leverage our operational leverage in that. So in that respect, pretty much covers all those. The fact that it's chicken, by the way, wasn't really our big reason for entering it. A lot of people think that was it. We want to get at this big chicken pie. Yeah. But the lower LSM segment is dominated by chicken, obviously, but it's really a protein discussion.
Yes.
So whether they're having chicken or they're having fish or they're having Russians depends a lot on how much disposable income they've got. So it's still quite a big portion of the business, the starch and the Russian component as well as the chicken.
You've indicated that this asset or this deal will be earnings enhancing from the first year. If you can elaborate on why, is it more profitable than existing Taste Holdings, or is it just that you're adding to earnings in a positive sense?
Yeah, so I suppose when we talk about earnings accretive, we try with every acquisition, and we've managed to get it right to date, is that even taking into account acquisition costs, transaction costs, that it must add to the bottom line in year one. And especially after we may have issued shares, it must add to the bottom line at a HEPS level after dilution of the shares. So that's sort of one of our check marks when we look at an acquisition, is the ability to be earnings accretive in year one.
How accurate are those forecasts? Because it's still a forecast, right? And so often acquisitions, deals, mergers never deliver on the synergies.
So, I suppose there's a stat somewhere that says that about 70% of all acquisitions don't actually work out. But yet, if you ask the CEOs, 70% of all acquisitions do exactly what they were meant to do. So there's clearly a disconnect between actual performance. But when you're forecasting for a business, they really, we found, you end up quite different to what you originally anticipated. But that is with the business that you've been in for 15 years, that happens anyway. So we really put a lot of work on getting year one right. And there we're quite maniacal about that. But thereafter the management team has got to do what they do around the business.
Yes.
So beyond year one, really it gets into the same realm of subject to everything else in the world that happens.
Yeah. So you refer to dilution. So this deal's being funded, the 17 million funded half cash, half test holding shares. So we do know that the market and this sector in particular is quite expensive. You're trading at a PE ratio of about 25.5. So I think the existing owner accepting shares probably demonstrates that he is also confident about your prospects and the value of those shares.
Well, certainly if you look at historically the listed companies that have issued shares, certainly in our segment, in every single case, had the owner taken shares then, they would have got substantially more value out of the acquisition in every single case. There isn't one that I know of where that wouldn't have happened. So certainly in our segment, and I think the reason for that is really simply that the businesses add so much real value to the acquiring business that it's not immediately apparent if you're outside sort of the understanding. So yeah, the owners took half in shares, which as you say is a great sign from their perspective of their commitment to what we want to do with it.
Carlo, what's been your experience in keeping the founder in the business when you do the acquisition? Now you've said John Hickman will stay on for a year, so it's a limited fixed time period, but yet you have to live with each other. There must be some tension. It's his baby, his way of doing things. Perhaps you have more of an institutional mindset.
Yeah. That's a tough one, and I think that there isn't a textbook approach to it. It really is about relationships. Historically, so we do have a view that when you buy a business, you buy it. It is yours. From you walk in, you change the locks, and you change the alarm code. That's certainly how we believe it. But I say that when we bought NWJ, Hilton, who was the founder, stayed on, and he's still a non-executive member of our board 5.5 years later. So our view to keeping John on is because we think it'll work. But we've also been opposed. We don't know, what'll happen. But we think that it could work, that there won't be this massive clash. And we try and keep the corporate part of the business away from our divisions. They must get on and they must figure out how to sell chicken or sell pizza or sell jewelry. And we try and keep the sort of bureaucracy that comes with being a corporate away from them.
So they're still free to be entrepreneurial in their thinking?
That's what we try and do. That's certainly what we try and foster in the businesses.
Yes. So is that similar to a Bidvest model? How would you comment on that?
It would appear to be that way, but I think it's more of a decentralized type of thinking.
Yes.
And I don't think out of kilter with what many companies would want to do. All of us say a lot of the same things. We just end up doing it or executing it very differently.
Yeah. Carlo, what would you say are the challenges in this environment of doing deals? I mean, we hear there's a lot of appetite for doing deals, but there's a so-called price expectations gap, so the sellers are wanting too much.
Well, when you started the program, you alluded to the consolidation in the food segment, and South Africa is quite different to a lot of other markets I've been to, that there is this big consolidation. And forget the listed companies, there are a bunch of unlisted companies that have got multiple brands as well. So certainly guys starting up businesses I know are thinking about who they're going to sell it to. So in some cases the earnings or the price expectations are just way off what we would pay. And to be honest, we just don't even get into those businesses because we just know that we're never going to get, and if guys start playing us off against one of the other listed companies, we just withdraw. And because we're quite clear about how we think we generate value.
So this was not an auction process. Was it sort of a one-on-one discussion so that you moderate any price developments?
In all transactions, the first time that I went down and saw these guys was 2.5 years ago. And it was only recently in the last couple of months that we actually got serious. But I've thought it's been a great business for quite some time. They've not been sellers for exactly the same amount of time until very recently. So it very much, in this case, was that. I think all acquisitions end up being, or more often than not, the result of some personal relationship that's been built over time.
Chemistry, that's important. And maybe touching on a bit of what we have covered, but you said many of these sort of startups, they design the business with the ultimate buyer in mind. Do you find that these deals, maybe you might not want to be specific about this particular acquisition, but do they have all the governance elements in place, or do you have to still do a fair amount of tidying up?
I can answer it directly, they don't. A lot of these small businesses are small businesses. And I think that one of the things that we're able to do is we're able to go in and try and get past all, if we had to send a bunch of auditors into the due diligence, I don't think half the businesses that have been bought in South Africa would have been bought. Just because they've got a different risk profile, not because there's anything wrong with the business. So, that's certainly one of the things that we go in and do. So we do the due diligence ourselves in our team, including myself. We go and we visit franchisees, we visit stores, because otherwise there would just be too much, what would appear to be too much risk. But that's not actually the case.
Right. Now, You said you went down to see these guys, so the core, the heart of this business is in the Western Cape and the Eastern Cape. So is that your dream, I'd imagine, to sort of build it out further across the country and perhaps even across the border? It has one Namibian branch.
Yeah. So that's certainly part of our rationale, is that we've got this network of over 300 fish and chip outlets. We distribute to 580 odd food outlets around the country every week through our distribution centres. So it's really not that big a stretch for us to go to landlords where there's already a fish and chip shop and say, do you want, can we take another 100 square meters? Or to go to our existing 500 or so franchisees and say, here's another great investment opportunity. So that's certainly what we've got in mind. But the first 6 months, I think we'll just get to understand the business a bit before we make certainly any changes and do any aggressive rollouts.
On that leg, you spoke about property. How tricky is that part of the business to find more space, negotiating with the landlord on terms that are acceptable to you?
So I'd say that there's two distinct camps. There's the existing big malls that are quite difficult to deal with. And then there's, certainly in the areas where, in the lower income areas, there are a lot of opportunities there where there's a lot more deal making going on. And the balance of power is a bit more equally weighted than in the big shopping malls. I mean, the rentals in some of the big malls are staggeringly high for a food business that's also got electricity associated with it.
Mm. And then other deals likely, so you're focusing on this acquisition, bedding it down for another 6 months. Have you got your eye on other options?
The reality is that when we listed in 2006, we had a tactic as part of our growth strategy was to grow by acquisition. So we've always had that. So at any one time, we've got 5 or 6 irons in the fire. And you have to, because
it takes time, as you said.
It takes time.
Yeah.
So there's always something, and people that we're talking to, businesses that we would like to buy, or markets that we want to penetrate. So yes, there's always something on the go.
In closing, just give us a taste of what the consumer's looking like. We saw your interim results towards the end of last year, still looking good, but you did refer to a consumer under pressure.
So we certainly have seen in the last few months of last year a slowdown in the acceleration, and we were seeing great growth in the first half of the year. So we've seen some of that in some of our brands, but our view definitely going forward is that I think we're probably being as cautious as the rest of the market seems to be about consumers with the electricity hikes and all that stuff that everyone's commented on. So I also think that there's nothing wrong with a bit of time to clean out. I think that's quite good in a business to have that after a few years of a very good run.
Right, the consolidation we spoke of.
Yeah.
Carlo, thank you very much. Really good talking to you. That was Carlo Gonzaga, CEO of Taste Holdings. And that's it for this week's episode of Deal Flow. See you again next week, same time. From me, Erika van der Merwe. Goodbye.